Hello again, everyone. It is Thursday, March 10th, about 9:45 in the morning in Chicago, and this is your Daily 5. These are my 5 most important charts, data series, and models, internal models from Asbury Research that we think are the most important and are going to be the most influential for overall financial market direction in the days and weeks ahead. Number 1, market internals. The Asbury 6 is negative. For those who are familiar with me, either through StockCharts.com or through my company, Asbury Research, you might be familiar with our Asbury 6. Our Asbury 6 is a tactical model that we built several years back to try to deal with the changed character of the S&P 500 over the past several years or so. And by changed character, I mean what we're seeing this week. The day-to-day volatility, where the market is up 50, 60 points, the S&P 500 is up 50 or 60 points one day, it's down 100 the next, and then the day after that, it's up 70. If you're just focusing on the S&P 500, it's really easy to get fooled. It's really easy to get disoriented because, in our view, the day-to-day volume, the day-to-day movements of the market are really controlled by the algos right now, by the computers trading with each other. And I think a lot of that ends up being financial jujitsu, where these computer programs will push the market through a support level, get everyone short, or basically chase everyone out of their longs, and then they run them right back the other day and force you to get in the other way. And we see it day to day. So we built a model that still includes the S&P 500, but it focuses more on what I would call secondary indicators that can't be controlled by the computer trading day to day. And what we did to start was I made a list of my favorite tactical indicators throughout my career, and then we started to back test them as a group. And we didn't know at that time if it was going to be the Asbury 4 or the Asbury 8. So we found 6 indicators that worked really well with each other. They were different enough to each other where when 1 or 2 indicators gave a bad signal, which they all do, there is no such thing as a perfect indicator. We found 6 that when 1 or 2 are having an off week and they're in an environment where they're not working very well, the other ones will pick them up. So the way this works is the rate of change is the only Asbury 6 constituent that has to do with the price of the S&P 500, the rate of change in SPX. But then we're looking at stuff like relative performance between stocks and bonds, investor asset flows, corporate bond spreads, trading volume, market breadth, and we've teamed these together where 4 in one direction, either positive green or negative red, constitute a signal. So the Asbury 6 turned negative on January the 14th. The S&P 500 has declined by as much as 12% since then, and you can see right now this model is as negative as it could be. All 6 constituents are negative or red, and these numbers in the cells are the dates that each of these constituents turn negative. You can see the investor asset flows in SPY have been negative since January the 13th, meaning that there's a trend of assets coming out of SPY, which forces the price of SPY down. It means there's people leaving the market, investors leaving the market. So this is negative going in, and we've had a negative bias since then. Our other tactical model, the CPM, or the correction protection model, has been on a risk-off status since January the 18th. You can find out more about these models by visiting our website. Number 2, know your levels. The S&P 500 is in a major downtrend. It's testing support. So let's have a look. The S&P 500 daily, with its 200-day and 50-day moving averages going back to last April, is on your screen. The 200-day in orange, which many people view as the major trend, and the 50-day, which many people view as the minor trend. Something that got a little bit of press over the past 24 hours is the 50-day is starting to close in on the 200-day from up above. They call it a death cross. Personally, I don't think the crossing of these two moving averages is very important from a tactical standpoint and telling me what to do. But when you pinch them together like they are right now, especially with the D's third low right in the middle, this is a formidable resistance area from 44.67 up to 44.98. It's 6% above the market now. As long as the S&P 500 stays underneath this resistance, we're still in a major downtrend. And again, the Asbury 6 has been negative now for almost 2 months. The other point of interest here, I think, is the support. Again, the support levels and resistance levels don't hold like they did 5 or 10 years ago, I think, because the computers rule the roost during the day. I think 80% of the volume of the stock market during the day is algorithmic trading. But take a look at the support level from the May 2021 high to the July 19th low of last year to the October 1st low. All three of those kind of congregate in this 42.79 to 42.38 area. Tested once in January, held. Broke very hard. It was broken significantly intraday on February the 24th, but then there goes the reversal, and we closed back above it. We went down underneath it again on March 8th, and looks like we may be starting to roll over. If we do, the next support level is 2% underneath at 41.68. Number 3, the SEAF model, overweight, energy, and consumer staples. SEAF is another one of several in-house quantitative models that we have at Asbury Research. And what SEAF does, rather than measure relative performance, it measures the asset flows moving in and out of the 11 sector spiders of the S&P 500. And we measure this in 3 different time frames: trading, which is weekly; tactical, which is monthly; and strategic, which is quarterly. And then we look for trends of asset flows across the 3 time frames. So right now, the latest data, and we update this on the weekends on our in our research center, through the end of last week, and we'll be updating this again in just a couple days. Today's Thursday, we'll be updating this again on Saturday. But through last week, the data indicated a continued trend of inflows into energy since January the 6th, and a resumption of the February 21st trend of inflows into consumer staples. This is where the money is currently going in the sector space. Since SEAF went overweight energy has outperformed the S&P 500 by 37%. So even though the market has gone down, we have been able to capture some alpha here by being overweight energy effectively since the beginning of the year. The latest data also indicate a new trend of outflows from financials and a resumption of the January 10th trend of outflows from technology. So since January 10th, the same time that we were overweight energy, we saw that the money flows that were going into energy were coming out of technology. So we avoided technology and we overweighted energy. And all we're doing is following the money here. We're not trying to determine what the war in Eastern Europe is going to do to fuel prices. We're watching the money moving around the sector space, and we're jumping on these trends as we see them start to emerge. Number 4, the inflation trade. Metals and mining is shining. On February 25th, I was on a show, StockCharts show, called The Pitch, and I was on with 2 other analysts. It was a lot of fun. It was hosted by Grayson Rose of StockCharts, and one of my picks was metals and mining. The reason I picked metals and mining, the reason I was looking there is because we're in an inflationary environment and stocks are going down. So what we're trying to do is give our clients ideas that weren't directly related to the stock market, that weren't directly correlated to the stock market, So we started looking more in the commodity space for alternative investments while the stock market is in a major decline. And this is one that popped up. So here's February 25th, just to show you what we were looking at here. Here's the show, the pitch. This was the day that I was on with those other two analysts. And what I noticed is that the relative performance of XME, which is S&P 500 metals and mining ETF, the relative performance versus SPY, it was above its 63-day moving average, the green line here to indicate that it was in a quarterly trend of relative outperformance versus SPY. Good, we want outperformance. And we also noticed that it was starting to break its May 17th relative performance peak versus SPY. This attracted our attention. And then if you look at the actual ETF itself, it was in the process of breaking out from the June 1st high of last year. It was actually breaking out and retesting that as support. So we put that out as a long idea. It's risen by 20% since then, and it's outperformed the S&P by 19%. So we're using understanding what's going on in the world to try to find opportunities that may fit the environment. And then just we're using relative performance and some other tools to try to identify opportunities with very good risk-reward ratios like we had here. It was sitting on a support level and just starting to break an old relative outperformance extreme. Commodities have been a very good hedge during this period, and I believe they're going to continue to do so. Finally, number 5, staying with the commodity theme, gold is testing formidable overhead resistance. Gold was another good hedge. Back on February 8th, we put out a buy opportunity to our clients to buy gold. The reason we did is gold was starting to rise up above its 200-day moving average in orange here and its 50-day in blue. And again, we're in an inflationary environment, and we were looking for alternative investments, to get into. And then if you look down here, the relative performance line between gold and SPY, the S&P 500 ETF, it started turning in the beginning of February to a trend of quarterly relative outperformance. It came back to retest that trend. So we put a buy idea out there. It's done quite well. And I'm sure that I'm not the only person out there that's long gold right now. The reason that I want to talk to you about it today is because gold has had kind of a vertical move here, and it's bumping up against this August 2020 high of 194.45. Gold, by the way, we're using the Spider Gold Shares ETF, which is GLD. Its linear correlation to gold futures has been 0.99 for the past decade. So it's a very, very good surrogate for gold itself. It's actually measuring gold bullion. But the point here is if you have been long gold, you may consider tightening your stops. We did that this morning. We put our stops just underneath this little wiggle back down because I made a nice move here. I don't want to give it back. And typically when you get a giant move like this and you test an old level, there's a lot of people out there that have charts. They know how to read charts, and people are taking profits here or maybe even going short if they think gold has gone too far. So if you're long gold, that's something to consider. We are very aggressively tightening stops in here because we want to make sure that we capture most of this quick, nice move. It's not often that you can get this kind of move in this kind of quick time period, especially when the S&P 500 is going down, and it's much harder to find opportunities. So something to consider if you're long gold. So there you have it. 5 places to look for opportunities. And if you like our methodology, if you like the way we look at markets, feel free to visit us at www.asburyresearch.com and use the contact tab and ask us for more information. Have a great rest of the week, and we'll see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.